Hello ladies and gentlemen, welcome to my commentary today. In a conference room in Brussels behind closed doors and drawn curtains, European officials made a decision that would reverberate across the global financial system for decades to come. They agreed to seize not the principle of Russia's 300 billion in frozen sovereign reserves, but something they believe was more defensible, the interest generated by those immobilized funds. To European leaders, this felt like a clever compromise, a way to support Ukraine without crossing the ultimate red line of outright confiscation. But in Moscow, this distinction meant nothing. The Kremlin viewed any extraction of economic value from sovereign assets as theft pure and simple, and Russia's response would be swift, calculated, and devastating. Moscow announced retaliatory measures targeting nearly $1 trillion in Western corporate assets operating inside Russian territory, setting in motion a financial confrontation that would shake the foundations of the post-Cold War economic order. The origins of this crisis stretch back to February 2022, when Russia launched its full-scale invasion of Ukraine. Within weeks, Western nations imposed unprecedented economic sanctions, disconnecting Russian banks from the SWIFT payment system, and most significantly freezing approximately $300 billion in Russian central bank reserves held in European and American financial institutions. At the time, Western officials presented this as a temporary measure designed to pressure Moscow into changing course. The immobilization was framed as a freeze, not a seizure. International law distinguishes carefully between these two actions. Freezing assets restricts their use temporarily during a conflict or dispute, while seizure represents a permanent transfer of ownership. The former is generally accepted under certain circumstances. The latter crosses into territory that threatens the entire architecture of global finance. For 2 years, those reserves remained frozen but untouched. European officials understood that sovereign reserves represent the bedrock of international financial trust. Central banks around the world hold assets in foreign currencies and institutions based on the assumption that these holdings are sacrosanct, protected by international law, regardless of political tensions. Yet as Ukraine's financial situation deteriorated throughout 2023 and 2024, and as Western publics grew weary of open-ended aid commitments, pressure mounted in Brussels and Washington to find alternative funding mechanisms. European leaders faced a brutal political calculus. Ukraine needed an estimated $50–60 billion annually just to maintain basic state functions, let alone continue its military defense. Domestic political appetite for these transfers was eroding rapidly. The frozen Russian assets sat there generating interest, presenting what some saw as a solution and others viewed as a trap. By late 2024, the conversation in European capitals had shifted from whether to how these funds might be utilized, with lawyers constructing increasingly elaborate justifications for what was about to unfold. The mechanism European officials ultimately crafted was designed to maintain plausible deniability while achieving the practical outcome of asset seizure. Rather than confiscating the $300 billion principal, Europe would capture the interest earnings generated by these frozen funds, estimated at roughly $3.5 billion annually, depending on prevailing interest rates. Additionally, European institutions would use the frozen assets as collateral to secure loans for Ukraine, effectively monetizing Russia's reserves without technically touching the principal itself. The legal reasoning rested on several pillars. First, European lawyers argued that interest earnings from frozen assets constituted new income rather than original sovereign property, making them subject to different legal protections. Second, they invoked the concept of countermeasures under international law, which permits states to take otherwise unlawful actions in response to another state's violations. Since Russia had violated Ukraine's territorial integrity and sovereignty, Europe claimed justification for extraordinary financial measures. Third, and perhaps most creatively, European officials framed their actions as temporary utilization pending final settlement, rather than permanent confiscation. The principle would theoretically remain intact and could be returned if circumstances changed, though European policymakers privately acknowledged this scenario was highly unlikely. Belgium, which hosts Euroclear, the institution holding the majority of frozen Russian assets, initially resisted these measures strenuously. Belgian officials warned that using sovereign reserves as collateral or seizing their interest could expose Euroclear to massive legal liability and potentially destabilize the institution's role as a neutral custodian in global finance. Yet Belgium's objections were gradually overcome by a combination of a political pressure from larger European powers and financial guarantees designed to insulate Euroclear from potential losses. The final decision came in early 2025, with the European Union formally approving a multi-year loan to Ukraine backed by Russian assets and the transfer of interest earnings into a special fund for Ukrainian reconstruction. The announcement was carefully calibrated, emphasizing humanitarian necessity, legal propriety, and the temporary nature of the arrangement. European officials stressed that this was not confiscation, that international law supported their actions, and that the principle of sovereign immunity remained intact. Within European policy circles, there was genuine belief that they had found a middle path, a solution that supported Ukraine without completely demolishing the guardrails of international finance. This confidence would prove tragically misplaced. In Moscow, Beijing, and capitals across the global south, Europe's carefully constructed legal distinctions were seen as precisely what they were: semantic camouflage for a fundamental violation of financial sovereignty. If this explanation of Europe's legal maneuvering clarifies how Western powers rationalize crossing a line they once deemed sacred, hitting the like button helps this analysis reach others who are trying to understand these complex dynamics beyond the simplified narratives dominating mainstream coverage. Moscow's reaction was not driven by emotion, but by cold strategic calculation, refined over decades of navigating Western economic pressure. Russian officials had long anticipated that frozen assets might eventually be weaponized and had prepared contingency measures accordingly. When Europe formalized its decision to utilize Russian reserves, the Kremlin activated a retaliation framework that had been years in development. The cornerstone of Russia's response centered on a brutal asymmetry that Western policymakers had either overlooked or chosen to ignore. While Russia held $300 billion in frozen assets abroad, Western corporations maintained nearly $1 trillion in assets investments and infrastructure inside Russian territory. These holdings represented decades of capital investment across energy, manufacturing, retail, automotive, pharmaceutical, and financial sectors by companies from Germany, France, the Netherlands, the United Kingdom, Italy, Japan, and the United States. In the immediate aftermath of the 2022 invasion, many Western companies had attempted to exit the Russian market, but Moscow had made withdrawal extraordinarily difficult through a combination of bureaucratic obstacles, forced asset sales at steep discounts, and outright blocking of exits for companies in strategic sectors. As a result, by 2025, hundreds of billions in Western corporate assets remained operational inside Russia, effectively held hostage by a government now prepared to weaponize its control. Russia's retaliation took several forms, each calculated for maximum impact. First, Moscow announced new legislation permitting the temporary nationalization of assets belonging to companies from unfriendly states that had participated in sanctions or supported measures targeting Russian sovereign property. This gave the Russian government legal cover to seize control of the factories, retail chains, bank subsidiaries, and energy infrastructure operated by Western firms. Second, Russia imposed extraordinary taxation on remaining Western businesses, with effective rates reaching 80 to 90% on profits for companies from countries that had seized or utilized Russian assets. This made continued operations financially untenable while preventing clean exits. Third, and most significantly, Moscow threatened permanent expropriation, the complete transfer of ownership from Western corporations to Russian state entities or domestic private firms. Russian officials made clear this was not merely a negotiating tactic, but a binding policy that would proceed systematically if European asset seizures continued. The message was unmistakable: for every dollar Europe extracted from Russian reserves, Moscow would retaliate against $10 in Western corporate holdings. The strategic logic was devastating in its simplicity. Europe believed it could touch Russia's sovereign assets because they were frozen in Western jurisdictions beyond Moscow's physical control. But Russia controlled the territory where Western corporate assets physically existed, giving Moscow overwhelming leverage in any asset confrontation. European leaders had walked into a trap of their own making, having failed to account for the geographic distribution of vulnerable holdings. Moreover, Russia's retaliation served broader strategic objectives beyond simple revenge. By demonstrating that Western jurisdictions could not protect foreign assets from political seizure, while simultaneously proving that Russia would retaliate against economic coercion, Moscow sent an unmistakable signal to the rest of the world. The era of safe Western financial custody was ending. Understanding these competing strategic calculations requires examining not just the immediate actions, but the decades of context that led to this confrontation. If you're finding this breakdown valuable and are grateful for analysis that examines all sides of this conflict, rather than simply accepting one narrative, I genuinely appreciate hearing from you in the comments below. Your feedback helps me understand what research directions serve you best and which aspects of these complex geopolitical dynamics deserve deeper exploration in future coverage. The immediate economic consequences of this asset confrontation rippled across multiple dimensions, affecting corporate balance sheets, sovereign credit ratings, and the foundational assumptions of international investment. For Western corporations trapped in Russia, the situation represented an unprecedented crisis. German automotive manufacturers faced potential loss of factories worth tens of billions of euros. French retail giants confronted nationalization of their Russian operations built over 2 decades. British and American energy companies saw their joint ventures and infrastructure investments suddenly at risk of complete expropriation. The financial implications extended far beyond the companies directly affected. European banks that had lent money to these corporations, using their Russian assets as collateral, suddenly faced massive exposure if those assets were seized. Insurance companies that had provided political risk coverage discovered that their policies might not adequately protect against state-to-state asset confrontations of this magnitude. Credit rating agencies began downgrading companies with significant Russian exposure, triggering margin calls and forced asset sales that rippled through financial markets. Meanwhile, Europe's credibility as a safe custodian of foreign wealth suffered damage that would prove difficult, perhaps impossible to fully repair. The decision to utilize Russian assets, however carefully justified in legal terms, sent an unmistakable signal to central banks and sovereign wealth funds worldwide. The message was simple, and chilling assets held in Western jurisdictions could be frozen, seized, or utilized for political purposes, regardless of international law or prior assurances. This revelation prompted an immediate reassessment of reserve holdings across the non-Western world. China convened emergency meetings of its state administration of foreign exchange to evaluate exposure to potential similar actions. The People's Bank of China held over $3 trillion in foreign reserves, much of it in dollar and euro-denominated assets. Chinese officials began accelerating plans to diversify away from Western custodianship, increasing gold holdings, expanding bilateral currency swap arrangements, and fast-tracking the international infrastructure for China's digital yuan. Saudi Arabia and the United Arab Emirates quietly initiated similar reviews, concerned that their massive dollar holdings in U.S. Treasury securities could theoretically face restrictions if geopolitical tensions escalated. India, which had carefully maintained strategic autonomy between Western and Russian partnerships, drew the obvious conclusion that holding reserves in any single bloc created unacceptable vulnerability. The erosion of trust in Western financial neutrality manifested in measurable ways. Demand for European government bonds softened as foreign central banks reduced purchases, forcing yields slightly higher and increasing Europe's borrowing costs. The euro faced steady depreciation pressure as international investors questioned whether the currency could maintain its status as a global reserve asset if the institutions backing it could not guarantee political neutrality. Capital flows to European financial centers slowed as wealthy individuals and institutions from emerging markets sought alternatives less exposed to geopolitical risk. Perhaps most significantly, the asset confrontation accelerated the development of alternative financial infrastructure specifically designed to operate outside Western control. BRICS nations intensified work on parallel payment systems, commodity-backed currencies, and banking networks that could facilitate international trade without touching dollar or euro-denominated channels. As this financial confrontation continues to reshape global monetary architecture, I'll be tracking the development of alternative payment systems, the diversification of central bank reserves, and the broader implications for Western economic influence. Subscribe and enable notifications to follow this evolving story beyond the headlines. The confrontation between Europe and Russia over sovereign assets resonated with particular intensity across the global South, where decades of experience with Western financial power had bred deep-seated wariness. For countries in Africa, Latin America, South Asia, and Southeast Asia, the EU's decision to utilize Russian reserves confirmed long-standing suspicions about the conditional nature of Western financial relationships. These nations observed that the same international law Europe invoked to justify freezing Russian assets had been selectively applied throughout history, with Western powers consistently claiming exceptions when their strategic interest demanded it. The lesson was unmistakable. International law protects the powerful and constrains the weak. African leaders in particular viewed the asset seizures through the lens of their own historical experience with Western financial institutions. Many recalled how structural adjustment programs imposed by the International Monetary Fund had forced African nations to privatize state assets, often to Western corporations, as conditions for debt relief. They noted how African resources had flowed outward for centuries, while the continent remained impoverished, constrained by a financial architecture designed in Western capitals. Now watching Europe seize Russian assets while claiming legal high ground, African policymakers drew a direct parallel. This was merely the latest iteration of a system where Western powers write rules they expect others to follow, but violate whenever convenient. This perception fueled a broader realignment already underway across the global South. Nations that had maintained careful neutrality in the Russia-Ukraine conflict now leaned more explicitly toward alternative power structures. BRICS expansion accelerated with multiple countries applying for membership, precisely because the bloc represented an attempt to build financial and political institutions outside Western control. The asset confrontation provided concrete evidence that such alternatives were not merely desirable but necessary for genuine sovereignty. From a systemic perspective, the EU-Russia asset war marked an inflection point in the slow-motion fragmentation of the post-Cold War financial order. For 3 decades following the Soviet collapse, the world operated under a broadly unified financial architecture centered on the dollar, the euro, and Western-dominated institutions like the World Bank and IMF. This system provided stability and liquidity, but also concentrated extraordinary power in Washington, Brussels, and London. The weaponization of this power, first through sanctions regimes and now through direct asset seizures, accelerated the development of what scholars began calling a multipolar financial order. This emerging structure featured multiple reserve currencies, parallel payment systems, regional development banks, and commodity-backed monetary arrangements specifically designed to reduce dependency on Western financial infrastructure. China positioned itself as the primary architect of this alternative architecture, offering not just criticism of Western financial hegemony, but functional alternatives. The digital yuan provided instant settlement without SWIFT. The Asian Infrastructure Investment Bank offered development financing without Western conditionality. The Belt and Road Initiative created physical infrastructure linking economies outside Western trade networks. Russia, now thoroughly excluded from Western financial systems, became a key partner in this alternative architecture, providing energy resources, military technology, and geopolitical heft to what Beijing framed as a more equitable international order. The irony was profound. By attempting to punish Russia through asset seizures, Europe had strengthened precisely the alternative power structures that threatened Western influence. Yet the transition toward multipolarity carried its own risks and uncertainties. Alternative systems remained less liquid, less developed, and less tested than Western financial infrastructure built over generations. The dollar's dominance rested not just on American power, but on genuine advantages, deep capital markets, legal predictability, and a demonstrated ability to absorb global savings. Whether BRICS alternatives could provide comparable stability remained an open question. Moreover, financial fragmentation threatened to reduce overall global economic efficiency, potentially slowing growth and complicating international cooperation on challenges requiring unified responses. Given everything we've examined, I'm genuinely curious about your perspective on a fundamental question. Did Europe overreach by seizing Russian asset interest, or was this a justified response to Russian aggression that merely exposed vulnerabilities Moscow should have anticipated? More broadly, does the erosion of Western financial neutrality represent a necessary correction toward multipolarity, or a dangerous fragmentation that will ultimately harm global economic stability? Share your analysis in the comments. I read them all, and often they provide insights and regional perspectives I hadn't fully considered. Standing back from the immediate conflict, what emerges is a portrait of a global financial system in fundamental transition. The post-Cold War era rested on an implicit bargain: the United States and Europe would maintain the infrastructure of global finance, and in exchange other nations would accept dollar and euro dominance. This bargain depended entirely on trust that Western powers would not weaponize their financial control except in the most extreme circumstances and would maintain reasonable neutrality in their custodianship of foreign wealth. The EU's decision to utilize Russian sovereign assets, regardless of its legal justifications or moral motivations, shattered this trust irreparably. From Moscow to Beijing to Riyadh to Brasilia, policymakers concluded that Western financial neutrality was conditional and could not be relied upon for long-term planning. This conclusion set in motion a diversification process that will reshape global finance for decades. The confrontation over 300 billion in frozen Russian reserves and 1 trillion in Western corporate assets represents far more than a bilateral dispute. It is the opening chapter of a broader transformation in which financial power fragments across multiple centers, reserve currencies proliferate, and the assumptions that structured international economics for 75 years gradually dissolve. In the end, both Europe and Russia may discover they have lost more than they gained from this confrontation. Europe succeeded in channeling resources to Ukraine, but at the cost of its credibility, as a neutral custodian, potentially accelerating the decline of the euro's international role and encouraging exactly the multipolar financial order Western powers sought to prevent. Russia demonstrated its capacity for devastating economic retaliation, but deepened its isolation from Western markets and technology, forcing reliance on partnerships with China that may ultimately limit Russian strategic autonomy. The real victors, if any, exist in this scenario may be those nations and institutions positioning themselves as bridges between fragmenting financial worlds or architects of alternative systems. As this transformation continues, we witness not merely an economic dispute, but a fundamental reordering of global power relationships. The post-Cold War assumption that Western financial dominance would persist indefinitely has been replaced by the recognition that all empires, including financial empires, eventually face challenges to their authority. History may record the EU's seizure of Russian assets as the moment when the decline of Western financial hegemony became irreversible. Thank you for watching.